Aditya Birla Sun Life Mutual Fund and MoneyMile present your goals, dreams and plans.
Hello and welcome to Your GDP, which is your goal dream plan. It's a series where we seek to educate our viewers on what your goals are, what your dreams are, and what you can do to plan accordingly to achieve those goals. Joining me today is well-known personal finance trainer and author, Amit Trivedi. Thank you very much, Amit. A pleasure talking to you. Amit, we've seen a period of fairly low interest rates. And what this has meant is that traditionally we Indians tend to save more through bank deposits, FDs, money lying in savings bank accounts. And, that's really not beating inflation. It never did, and it isn't certainly today with the kind of rates we are at. How can a mutual fund help you in beating inflation?
So first of all, once again, as far as the interest-bearing products are concerned, two separate categories of investors need to be, considered in this case. Number one, those who are accumulating and using fixed income products for that purpose, but their need is to save for a longer period. Whereas the other category who is withdrawing money and generating income out of the portfolio. The second category would be hit very hard when the interest rates fall. In case of the first category, the impact is not going to be that hard simply because both inflation and interest rates have come down simultaneously. So on a net basis, net of inflation, they are not losing out much. Whereas the other category, while the rate at which the expenses are growing has come down, which is inflation, the expenses, the rupee number doesn't drop. And to that extent, a falling interest rate hits them very hard. If that's the case, let's look at possible solutions from mutual funds. And in mutual funds, one can generally look at debt mutual funds, to replace their debt-related investments. But will all debt mutual funds be able to do better than debt investments? Not necessarily. Certain risks need to be taken. And one of the risks that typically people take is the credit risk in debt funds. So instead of a bank deposit, if I get into a corporate bond fund or a credit risk fund, the earning could be on a higher side, but I'm still carrying slight amount of risk in comparison to a bank deposit. So that's number one that I need to understand. However, most financial planners and advisors would not recommend debt for the purpose of beating inflation over a longer period. There needs to be some slice of equity, because equity as an asset class has the potential to beat inflation over a long period of time, which means either you go with a hybrid category fund with some amount of equity, or some part of the portfolio can straight away be invested in equity mutual funds. How much should it be? It depends on the individual situation. So the answer for that question would be different for different investors.
It's been a pleasure talking to you, Amit Trivedi. Thank you very much for coming by and sharing your perspective with our viewers. Thank you.
Thank you so much. Pleasure is mine.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.